All right. Good morning, everybody. Yeah. It is a long weekend, so you got to keep that in mind when we are considering price action through the day. Why would they load up on big positions right in front of a 3-day weekend with a lot of unknown? So sideways would be the base case argument and or a continuation lower off of this headline that just came in. This one, Trump targeting Apple, upset with them because they had a headline that they were going to increase iPhone production in India, which is counter to what the president had already been talking about Apple bringing their production back to the US, and it made them look good. And then they said that it kind of makes him look like he's making promises that he can't keep. So now he's threatening them with tariffs. And that's not the only thing hitting the markets this morning. That's just the latest one. If you happen to take a look around at everything else this morning, one of the big things is bonds and the big, beautiful bill that barely made it out of the House getting sent to the Senate, and how the bond market is now lifting up their bond vigilantes in an anticipation that they're going to make the government listen. We'll see how that goes. So we're kind of sideways, down a little more now after that Apple headline, but otherwise mostly sideways this morning. We did not have a lot of economic events on the schedule. By noon today, we're pretty much good to go. The afternoon is supposed to be pretty quiet. Once we get done with Cook, which is at noon, we would be done. At this point, though, I would not be surprised if we get one of those Friday late afternoon data dumps. So, I'd be mindful of that. Keep your eye on treasuries today. It's going to be one of the big events. I don't think the 0-day options are going to be as influential today. But speaking of options, the Spot Gamma website is down. Can't get logged into it. And so when they are back up and running, I will share over the things that I typically share, the levels and the founder's note and insights. But at the moment, we just don't have them. I'm going to try something a little different today. This is the same chart that I would use on Thinkorswim, but it's on TradingView. So the 4, 10, and 20-day moving average, the 10-week moving average, just like we have it on Thinkorswim. Since we don't have Spot Gamma's levels, they are not here to see. And then the overnight volume in a cumulative representation. Now, I don't have a nice little label like on mine, but it's around 126K. We've been seeing it at this time, most mornings coming in at around 70 to 80. This is not the same indicator, so the numbers won't match perfectly, but it does give you a representation of what the overnight volume looks like in relation to where it's been in the previous days. So if we look at 7:30 and just look across the screen to the left, we're running at about an average right there. Doesn't really stand out as something significant this early in the day. If they were in here hitting it hard, it would look a lot like this. We have this deeper shadow showing a above average push. We don't have that this morning. perhaps a slight shadow, right? That's it. So we're under the 10. And if we break 5,800, we're going to be challenging that 20. And the 10 week is still way down here, long ways off. The ADR, just like on Thinkorswim, we're getting close to the lower red line. If we get there early enough in the day, we could flip and go back the other direction. To get there, we would have to break yesterday's low. But to hit the other side, we'd have to break yesterday's high. So we're looking at an inside day, and we have to GTFO to get anything done. It's a fairly narrow range, all things considered. And we don't have anything really pressing today to get us out of this box other than headlines. Even the Fed speakers that are supposed to be speaking, they're kind of low on the totem pole. And so far, they just keep reiterating the same thing that they've been saying. And they're all singing from the same hymn book, and nobody's willing to get out of line. So we're not expecting anything out of them today that we haven't already heard before. What's going to get us out of the box today? So far, that would be negative headlines, sending us to the downside. 5,800 is really the last hurrah. We get underneath that, we've got a nice drop to the downside. So a quick shot down to the lower ADR if this one doesn't hold. But we would still want to get outside of yesterday's range. So that lines us up with the idea of 111 and 1236. We got the half back of yesterday. So if we do break down to get through the 111, the 1236, and see if we're done there and we come back in again, or we continue moving to the downside beyond that. If you haven't heard it before, yesterday I had a lot of people tell me that they got chewed up in the first part of the day because they don't really do good in a sideways market. My response was, why did you even get in it? You already knew it was sideways. Basic trade logic 101 as a day trader. If you are inside of yesterday's range, you are in trash. You can trade it if you want to. Nobody says you can't trade it. You shouldn't, right? But if you don't do good in a sideways market, don't trade if we are inside of our own price action. We're inside of our own Globex. There's nothing here that you want to do. If you're looking for a trend trade rather than a sideways trade, GTFO, get out of the box. Basic trade logic, right? Today's no different. We have our Globex range. We have yesterday's range, which is wider than today's range. Get out of this box, get out of that box, and then you've got somewhere to go. Central pivot range. Today's floor pivot, it's green as a channel because we opened above it. Of course, we didn't keep it. We've already dumped through it. We are below the weekly floor pivot. The channel today is kind of narrow compared to yesterday's channel, which implies if we break out that it could stick and we could continue to move farther outside the channel and not come back in. Just be mindful that these channels don't make price do anything, right? The channel isn't going to make us break out, and it isn't going to stop us from breaking out. It just gives us insight on what to expect if we do break out. Now, this chart is a little different than what I have on Thinkorswim because there's no TPO with it. It's just the volume profile. We can see yesterday's, we've already hit it, which is why it didn't extend. But if I scroll back, there's the point of control from the 21st. It did it by default. It just extends it forward. And the same thing with the one on the 20th. It just extends it for you. You don't have to go in and draw it every day. And if we scroll back into a higher time frame, we find that there's a lot above us and below us. If we head to the downside, we've got these previous points of control to deal with. So you can kind of get it automated. I think even on Thinkorswim, there's been a few people who's automated that over the years. I tend to draw it by hand, but whatever, you can do it, in automation as well. This is the same one that we use on Thinkorswim for the week. So we can see this week's point of control really put in a lot of work down in the lower part here. But we also have last week's. Now, unfortunately, on TradingView, to have these previous weeks, I had to draw them by hand. So I only went back 1 week. But of course, if we want more weeks and we want it on a higher time frame, this would be the hourly. The point of this is you can do most of the charts that I do on Thinkorswim in the morning with TradingView. One of the few that you can't do is the weekly expected move, simply because TradingView doesn't have options data. And if you don't have options data, then you can't develop a weekly expected move. You have to do it by hand and put the levels in there. 10-day, 20-day, 10-week, right? Now, we've been talking this week about a higher low and whether or not we were going to get a decent higher low. We've definitely got it. The thing is, it's not done yet. We have to come up off of this low for us to say that the low is in. As long as we are still falling, then we haven't got our low yet. It's still developing. And that's where we're at right now, right? Same thing back here. While it was falling, it was just falling. Only after it pivoted back up did we say that we had a higher low. So we don't have it yet. This isn't a higher low yet. And it needs to be established. That's where we're at. We don't have that established. If we continue this drop to the downside, we've got the 20-period moving average, which lines up with the open of this day, pretty close. There's a lot of structure there. And underneath it, we got the gap that needs closed. It's really hard to see that we get that close to the gap and we don't just go ahead and get it done. But it's not the only gap we have. We got another one down here that we left behind. They say markets like to fill those gaps, but we've got gaps that go all the way back to like 2800s and 3200s. They were never filled. Although I'm sure some analyst somewhere will say, well, they will someday. Don't write them off. Okay, yeah, but that doesn't help us right now. So if we do get below the 20, then we look to get outside of this big candles range. We will want to break that low, get through the 50, and get that gap closed. It still comes down to level by level, right? Get to the 20, because that's the obvious target. Round number 5750, and then get outside of this big bar for a chance to close that gap. We might get that chance a little sooner than we wanted. $57.82, and you can see the market maker move up here. The market maker move is an additional amount of movement, right? So our average daily range is 1.5%. We would add another 1.9 on top of that, which gives us a total measurement for today of 2.5%. It's starting to go down now, so they're already beginning to unwind that market maker's move. Another way to consider what this is you take it to the yellow line and then move down even more, so another 60 points, and you take it to the top and you move up another 60 points. It's another way to visualize the market maker move on the day. That narrow central pivot range gave us an idea that if we did break down, it was likely to stick. Yeah, well, it's definitely doing that. We have S&R levels to consider. We're already through S2. The next level would be 57.31 cog line. On the week, we had a reasonably decent distribution. We left it all behind and have been putting in a lot of work down here. We've mentioned a lot this week that it gets really shallow, that if we did start to break down here, it's likely that we just keep going all the way down into 57 because there's not a lot here to help us out. But as I mentioned yesterday, it's not just about the footprints, right? There's other things that we can hit, moving averages, measured moves. There's a lot of things that we can hit besides volume, and old volume at that. They may be able to slow this descent. That really sort of highlights what we're working with, right? There's nothing here. Really nice value area that we've left behind. It's a tight consolidation. We had a few days left before we were going to start eliminating this volume. Now we've just got to be mindful of where's the point of control going to go when it does move. And at this point, we don't have anything else to move to. What you see down here won't be here by the time we start wiping these out. Classic P-shape profile at this point this morning. Yesterday with a really classic D-shape profile. These are the standard volume profile shapes that they teach in the books. We would approach them in their use the same way. No discrepancy, by the way, between TPO and point of control this morning. They line up really nice, other than this little bit of volume right here kind of stands out, right? Which was from that work right before it finally dumped. We don't see any of that on the TPO, which implies really large trades, just not a lot of trades, right? Up here, there was a lot of trades. Down here, there was not a lot of trades, but there sure was a lot of volume in the trades that we got. So big trades. We are now 1% below the 10-day. That's not extreme. We have not gone too far, too fast. It does not owe us a rebound back in the other direction. At this point, there's nothing here. Just recognizing that we're down 1% below the 10-day is all we have. As for the 10-week, 1.5% above the 10-week still means that we are above the 10-week and we're coming back down into a reset point. So we want to see how it responds when we get back to it, whether we're going to hold above it and or dump below it. That is the mean or fair price if you want to see it from that point of view. So we want to see the sort of price action we get when we get back to the 10-week. We are outside the range for the week. Statistically speaking, we should close inside this box 80% of the time. 70% is what is expected, but the S&P is the most accurate expected move product in the world, and it generally hits 80%. But that's on a historic precedent if we go back years and looking at how accurate it is. In the short term, when it fails to close on Friday inside this range, again and again and again, it's a warning and a heads up that the markets are still broken, that market makers are still having a trouble pricing in that volatility, and that there's still a whole lot that's happening underneath the surface. This week is not something new. Last week we closed outside. 2 weeks ago before that, we closed outside. And the week before that, we closed outside. Kind of get the idea, right? We've been closing outside the box a lot. We're not seeing 70%. We're not even seeing 50%. We're closing inside the box like 40%. So this weekly expected move range is not very useful right now from an iron condor perspective, or containment of price perspective. And instead, if you wanted to flip it around and trade the kind of options trades that will pay you for a move, then it would be like an inverse iron condor, which we call a gamma iron, right? So instead of selling an iron condor, you would buy an iron condor, but you wouldn't really want to do that, right? It'd be a little more like a strangle or a straddle, because if you buy an iron condor, if we stay in the box, you lose. If we get out of the box, you win, right? It's the opposite of a regular iron. Next week is a short week. This indicator does not function well on short weeks. We had one back here, for an example, where new contract change. And now that I zoomed in, probably makes it hard to see what we're looking at. There's the green, there's the Friday close of the previous week, and there's the red. It was a very compressed box simply because a new contract change. So there's a few different things that can screw this indicator up. A short week is one of those things. So these lines for next week, not very good. You'll want to hand draw them after the close tonight around 4:15, 4:30, and before Sunday morning, because at some point on Sunday, we'll start to see the options being moved. You'll want to go into the options chain and look at Friday's expiration. That will be the number that you want to use. So wherever we close, add that number and then subtract that number, and that'll be next week's range. But you don't want to do it now. I want to wait until after 4:15 and that number quits moving. I've got videos on that indicator, by the way, that I've done over the years. Should be able to just search weekly expected move and find it. If not, if you can't find it, let me know. I'll send you a link. So looking at what's down this morning, nearly everything that we would want for a rally. Communications, technology, banks, the Mag 7, financials, Bitcoin, chips, everything is down that has weight or influence that we would need. And looking at what's up, we have the VIX. Yay. And uranium, oddly enough. I was looking around on my uranium list. Not, I don't know, it's going to have to be a headline somewhere, right? One of those, because this is an ETF. One of the names in this basket must have had a really good move. I just didn't have time this morning fighting with Spot Gamma, trying to get into their website to figure out what pop this came from. So, I don't know, it's a headline somewhere, get it figured out. So uranium's up, precious metals, or at least the miners, are up. Sure, why not? Pile it on. Now, other comments about recommending a 50% tariff on the European Union. See the dollar making a shot towards 100. To be fair, we do have the 10-year moving down now. I believe that's very likely what the goal was, right? That's all we were hearing all morning is the yields are up, bonds are going to be down, bond investors are bond vigilantes and blah, blah, blah. And now smack. Aha, thank you, George. Trump is going to issue executive orders today on uranium. I appreciate that. I hadn't had a chance to go find that myself. You got any attribution you could add, like where you got it, so we can send to people in that direction? Bloomberg, Yahoo News, something. But thank you for that, because now we at least know what's moving the uranium basket this morning. All right, SMH and IWM are fighting neck to neck on who's down the most. Behind that, we've got NASDAQ, Bitcoin, generic tech, crude. Sure, just pile on to the problems. We got crude down, Mag 7, finance, energy again, energy, industrials, crude, healthcare. We kind of split the difference there. At Nat Gas, it's where we lose our 0.5%. And then down on the other end of the spectrum, uranium, precious metals, bonds, pot stocks. Silver's not down with gold, oddly enough. Generally speaking, one of those two is going to be the liar. So considering that gold and gold miners are up, excuse me, yeah, no, they're up. Silver should play catch up, right? It should get up here with the rest of them. Gold's at 1.7, silver's barely at a quarter of a percent. So one of those needs to play catch up, or gold's likely going to turn around and fade back down to silver. We'll see how it normalizes today. I appreciate that, though. We'll find something through the headlines. So at this point, when I started to stream, the idea was GTFO, right? Get outside the box and we have a play. Well, ta-da, we got that. That's simple enough. Even the measured move has already been taken out and it didn't even slow down, right? Find something a little bigger to use. There's the range for the whole week. Or we can find a candle of control. Yeah, no, nothing else really. These are just like CPI, PPI, non-farm payrolls, right? Got the liquidity gap in play. The move has to stop before you have a chance to close the gap. This is the gap that needs closed now. It's not a price action gap, it's just a liquidity gap. 58.42 is where we would expect to try to get back to after it's all said and done. Very likely it won't be today, but there's always the possibility that we get some sort of reversal something, right? So a 3-bar play, 2-bar play, at this point, it'd be like a morning star reversal, something like that. Cahold, CAHOLD, candle at the high of the lowest day, only it wouldn't be a day because we're on an intraday chart. And it's interesting that yesterday afternoon I put on a relatively wide trade. I was more just shopping around than anything else, right? I was trying to find something that had a little bit of weight to it. So I put on an SPX long put vertical. Long put, that means I bought puts, right? I bought 54.15 on the SPX. And on the other side of it, I sold 4,900. So, it's a 515 point wide put vertical for May 30. It's probably still in the Analyze tab. I picked that up for 95 cents. And when I was talking to people about it yesterday, my recommendation was get it cheaper if you can, because mine filled instantly. So you could have easily tried to work the order and picked it up for 80 cents, maybe 85, right? Something better than my 90 cents that I got. Now, this isn't where my trade is. Mine's on a different platform. I was just looking at it here in the Analyze tab. You can see the break even is all the way down here, 5,400. We're not expecting that, but 515 points wide, I don't need to get all the way down there. We only got to start moving in that direction. And we're moving in that direction. So we'll see. This thing's got a lot of time left on it. If we drop 100 points in the first 36 hours of putting on a spread this wide, it probably won't pay very much. We need to move farther than that and have it for longer than that. But it's a good start. If I knew it was going to happen this fast, I wouldn't have had a spread. I would have just had the puts. 95 cents. It's not exactly a $5 lottery ticket, but it had time to it, right? It's for May 30th. Plenty of time to do something with it. Maybe you spread it apart, turn it into a butterfly, do something. At this point, it's hard to say what those options prices would be when we get into the open. If you can still work the order and get something cheap, then why not, right? But you would probably be better off focusing on one of the Mag 7 names or one of the sector ETFs. I wouldn't try SPY or QQQ. The options prices would just be too extreme. They already have been, right? That's one of the reasons I had to go so far out of the money just to find something even viable at this point. And the strikes that I picked had significant trading volume yesterday. So it stood out. Somebody else was already loading up on those, and I just liked the price and picked it up myself. So the takeaway, watch for a V bottom, right? That at some point we could just flip and get and run back up the other direction. It doesn't have to happen. We can get to these lows and then just stagger down here and spend the rest of the day going sideways in a narrow range. It doesn't have to go back up. But the base case argument is that we do go back up, that there'll be some other headline, some other gotcha that pushes us back in the other direction and tries to get us back inside the box. The problem is we broke the line in the sand that we mentioned all week we really didn't want to break because there wasn't a lot down here to help us out. The options aren't down there. The volume footprints aren't down there. Really, there's only like some moving averages and that's it. We don't want to lean on moving averages to hold price up. That's like a bad idea. So now that we're on the move And we went right through the 20 without even stopping. 57.32 cog line, cut through that, and we've got 57.11, the 50 period moving average. And then we can get that gap close. Otherwise, look for a base and or a flip, something very quick. This is a good representation of Cahold. It's not perfect, but it'll do. Candle breaching the high of the lowest candle. So CAHOLD. This is like a sloppy reversal instead of something a lot cleaner, like a 2-bar, a morning star, something. But look for a flip or a base. I would not expect this to just continue to dump all day long. And watch the clock. Should happen on a new half hour or a new hour. Maybe after Europe closes too. So we'll see. Everybody have a good weekend, a nice long weekend, and we'll see you back on Tuesday.